Most people think they're doing okay financially. You work, you get paid, you pay your bills. You save a little. Nothing feels wrong. But something dangerous is happening quietly in the background. Every year, the cost of living in America rises. Rent rises. Food rises. Insurance rises. Health care rises. But if your money is sitting in a bank account, it isn't rising. It's shrinking. Not visibly, not dramatically, but slowly. And slow financial decline is the scariest kind because you don't feel it until years have passed. One day you wake up and realize you worked hard, but your money didn't. And that's the difference between people who struggle financially and people who build wealth. It's not intelligence, it's not luck, it's not even income, it's ownership. So in this video, I'm going to explain stocks in the simplest, clearest way possible. No complicated jargon, no confusing charts, no hype, just the truth. Because once you truly understand how stocks work, you stop being just a worker and you start becoming an owner. Part 1. What is a stock really? Let's imagine something simple. A small company starts growing fast. They sell a product people love. Customers increase. Revenue increases. But now they need serious money to expand. They want to hire more employees, build more locations, create better products. They need millions of dollars. They have two choices: take on massive debt or sell ownership. Instead of borrowing money and being under pressure, they decide to divide the company into small pieces. They sell those pieces to investors. Each piece is called a stock. So when you buy a stock, you're not just buying a number on an app. You are buying ownership in a real business. If the business grows, your ownership becomes more valuable. If the business struggles, your ownership loses value. That's it. That's the stock market. It's not magic. It's not gambling when done correctly. It's ownership. And here's something most people never realize. The wealthiest people in the world don't just work for money. They own assets. They own businesses. They own shares. They own investments. Ownership is what separates workers from the wealthy. Part 2. Why companies sell stocks. Think about the biggest companies you know. They didn't become massive overnight. They needed money to grow, lots of it. Instead of borrowing billions and living under debt pressure, they offered shares of their company to the public. That means regular people could become partial owners. You don't need to own the whole company. Owning even a tiny piece means you benefit when the company grows. This is one of the most powerful ideas in finance. You can own part of businesses you never built. You can benefit from growth you didn't personally create. That's what investing allows. While most people only earn money from their job, investors earn money from companies growing, and over time, that difference becomes massive. Part 3. How investors actually make money. There are only two real ways investors make money from stocks. Stock price growth. Let's say you buy a stock for $100. Over the years, the company grows. Revenue increases. Profit increases. Demand increases. Now that same stock is worth $400. Why? Because the business became more valuable. So your ownership became more valuable. You didn't need to work extra hours. You didn't need a second job. Time did the work. This is how long-term investors build wealth. Not through quick trades, not through guessing, through patience. 2. Dividends. Some companies share profits with investors. They send you cash regularly just for holding their stock. Imagine getting paid for owning something. That's what assets do. They work for you. Most people only understand earned income, money from work, but investors understand ownership income, money from assets. And over time, ownership income can become powerful. Part 4. Where people buy stocks today. Years ago, investing felt complicated. You needed brokers, phone calls, paperwork. Today, you can start investing from your phone in minutes through investing apps and online platforms. Technology is not the barrier anymore. Knowledge and fear are. Most people say, "I'll start when I have more money," but that mindset is expensive because time matters more than amount. Someone investing small amounts for 10 years often beats someone investing large amounts later. Why? Compounding. Time multiplies money, but only if you start. Part 5. Types of stocks. You don't need to become an expert to begin, but here's the simple idea. Some companies grow aggressively. They reinvest profits to expand faster. Others grow steadily and pay consistent income. Both can build wealth. Beginners often feel overwhelmed because they think they need perfect knowledge. You don't. You need understanding, patience, and consistency. The biggest mistake isn't starting imperfectly. It's never starting at all. Part 6. The real risk nobody talks about. People say the stock market is risky, but let's talk about the real risk. The real risk is working for decades and still feeling financially stuck. The real risk is saving money that slowly loses value to inflation. The real risk is relying only on a paycheck in a world where expenses keep rising. If your money doesn't grow, your life becomes more expensive over time. Not suddenly, gradually. And gradual financial pressure is the hardest to notice because every year feels normal until one day you realize you're far behind where you hoped to be. Investing isn't about getting rich fast. It's about not falling behind slowly. Part 8. Why time matters more than money. Most people underestimate time. They think investing is about how much money you start with. It's not. It's about when you start. A person investing small amounts consistently over many years can build serious wealth, not through luck, through time. Time allows compounding to work. Compounding is simple. Your money earns returns, those returns earn returns, and over time, growth accelerates. But compounding only works if you give it years to grow. Waiting is expensive. Starting early is powerful. Part 9. Emotional reality. Right now, there are two types of people watching this video. People who understand this and slowly begin investing, and people who say, "I'll do it later." 5 years from now, their financial lives will look very different, not because one got lucky, but because one started. You don't need thousands of dollars. You don't need perfect timing. You don't need to know everything. You need a decision to stop standing outside the world of investing and start owning a small piece of the future. Because the biggest mistake isn't losing money in the market. It's never giving your money the chance to grow. Final reminder. If you take one lesson from this video, let it be this. Working for money is important, but owning assets is what builds wealth. Start small, start simple, but start. Your future self is depending on the decisions you make today.